So, maybe you got a little bit of money back from taxes, or maybe you just got a bonus from work, or whatever the case may be, you found some extra money. And you've paid off most of your debts, and you're like, you know what, I really want to invest this. You start looking, you're like, man, I don't know if I want to, what I want to invest in. Well, some of the easiest things to invest in are mutual funds and ETFs, and you might be thinking to yourself, well, which one's better? Let's talk about that. Is it mutual funds versus ETFs, right? Specifically, the index mutual funds and index ETFs, because investment can be either active or passive. With the active approach, as you purchase, you're going to hold and sell securities and make decisions based on fundamental research of a company or industry, in particular, and of the national and global economy in general. And by contrast, the passive investment approach entails replicating a benchmark or index of securities that share common traits. Well, let's start off there. Active versus passive. And active investors believe that they can beat the market and earn what's called alpha. Passive investors maintain that market inefficiencies over the long term get ironed out, right, or arbitraged away. In the that's professional talk, right? So attempting to beat the market is fruitless. Passive investors simply desire to achieve what's known as beta, or the market return. Now, for the typical individual investor, passive investment is best accomplished through two choices. First, an open end investment company, otherwise known as a mutual fund, or an ETF, an exchange traded fund. Now, because both types of funds track an underlying index, differences in performance typically result from the tracking error or degree to which the fund fails to replicate the index. Additionally, the cost of an ETF can be lower than its mutual fund counterpart, a difference that can affect performance as well. Another important consideration that bears on performance is investor behavior. What follows is a basic discussion of, main attributes of each and under what circumstances one would use them. Well, let's talk about a truly passive investor, right? Because a truly passive, this individual wants to achieve optimal asset allocation best suited to their objectives at a low cost and with very little activity. Now, for this investor, the index mutual fund would be preferable. A typical adjustment in exposure would be achieved through rebalancing on a regular basis to maintain consistency with, your specific goal. So, should circumstances change, the adjustment of, your allocation, and then, the tactical changes, they're easily accomplished, right? It doesn't really take much. A truly passive investor purchases an index and then basically sets it and forgets it. Trades would only take place when the index's composition is changed as companies are added or dropped by the index provider. And with a truly impassive investor comes the not so passive investor, right? This individual shares many of the goals of the, truly passive investor, but may exhibit greater, shall we say, sophistication and want to affect changes in their portfolio with greater speed and precision. For this type of investor, the ETF would be more appropriate. While taking the passive approach, like its older mutual fund cousin, the ETF allows the holder to take and implement a directional view on the market or markets in ways that the mutual fund just can't do. For example, as with shares of common stock, ETFs trade in the secondary market. Investors may purchase and sell them during market hours rather than be dependent upon forward pricing, where the traditional mutual funds price is calculated at what's called NAV, or your net asset value, and this happens after market close, right? Additionally, investors may short sell an ETF. So the passive investor who may be, waiting to be opportunistic, right? they're going to be inclined, right, to be opportunistic. They're going to relish in the greater flexibility that this vehicle affords them. Tactical changes and market plays may be executed pretty quick. The one potential disadvantage is the accumulation of trading cost as a function of one's trading activity. Using ETFs in the way we just talked about is an active application of a passive investment. The investor should understand market dynamics as they affect asset class behavior and be able to understand and justify their decision making process. Not forgetting that trading costs can reduce investment returns. Investors should understand that attempting to practice the hedge fund strategy of global macro, right, taking directional bets on asset classes to achieve outsized returns, is similar to a marksman attempting to achieve the range and precision of a high-powered rifle with a 22 caliber gun. Smart beta investing combines the benefits of passive investing and the advantages of active investing strategies. The goal of smart beta is to obtain alpha, lower risk, and increase diversification at a cost lower than traditional active management and marginally higher than straight index investing. Now, it seeks the best construction of an optimally diversified portfolio as well. As with anything, there's some special mentions, some additional considerations. Um, you know, Notwithstanding everything we talked about, there's several other features of which individual investors should make note when deciding whether to use an index mutual fund or an index ETF. Mutual funds have different share classes, sell charge arrangements, and holding period requirements to discourage rapid trading. The investor's time frame and disinclination to trade will dictate what product to use. ETFs are built for speed, all else being equal, as they carry no such arrangement. Mutual funds also often have purchase minimums that can be high, depending on the account in which one invests. Not so with ETFs. There are tax consequences, however, to investing in either a mutual fund or an ETF. The mutual fund can cause the holder to incur capital gains taxes in two ways. So, you know, all in all, everything said, if you're considering an index mutual fund or an index ETF, the individual investor would do well to consult an experienced professional who works with individual investors of differing needs. No two individual circumstances are identical, and the choices of one index product over another results from a set of circumstances. As with any investment decision, I want you guys to do your homework, do your due diligence. Look into these things. What works for me might not work for you, might not work. I say this over and over, and I'm sure you hear this from other people over and over. But what you need is different from what anyone else needs. What you want is different. How you want, do your homework and make something that works for you. Hopefully you guys got some good information out of this. Hope you learned something. If you did, go ahead and hit that like button. If you're not subscribed to the channel, man, I really appreciate if you did. But until I see you guys in the next video, y'all be safe.